Hi, everyone. Welcome back to Capital Consumption Theory. I'm here today with Brian Winters, and we're talking about money demand and inflation. Um, so, where
So
should I start?
inflation's kind of on people's minds these days, right?
Yeah, it is. I wrote an article recently called "The Solution to Hyperinflation: Risk is UBI." And I've been finding lots of places to drop that because everyone's talking about inflation ever since I think it was the yesterday or day before, and the print came out at 6%.
Yep.
Um, Surprise to the upside. Everybody's talking about it.
No,
You
and
were
well,
mentioning,
different countries have different goals, right? Is 6% bad because our goal is supposed to be 2%? But I know countries like India, right? 6% is within their target range for inflation.
yeah, that's an interesting question. And a lot of countries are just used to dealing with much higher inflation. Like, a lot of smaller countries with smaller currencies. It's quite common for them to, just stay around like 5, 10%, or even, 20 or even higher. Um, so to some degree, they're used to that. Um, Money is not the primary thing. The primary thing is income and spending, and distribution of income and growth of income and growth of spending and production. Inflation is not the main thing, but inflation can have an effect. And so inflation is one of those things that Claudia Sahm, a few weeks, maybe months ago, tweeted something like some report, and she summarized and said, um, economists don't understand inflation. And I think that's actually an accurate
Well, I mean,
description
because
of
there's
standard
so many
economics.
moving parts to inflation, right? I mean,
It
it's
is.
it's you know, some people just say, oh, well, any increase in the money supply that causes inflation, but it's that's
That's
one
too
of the
simplistic.
gears, but that's way too simplistic.
Yeah, and then on the other side, a lot of times you'll get like this economist speak where, um, if you ask about inflation or other things too, like they'll say, well, you have A, B, and C factor, pointing in this direction, and then you have E, F, and G and H factor pointing in the other direction. So, it may do this, but it may do that. And they can see this, and they can do that in a very sophisticated way, and it sounds like they really know what they're talking about. Lots of analysis, very knowledgeable, clearly an expert.
Kind of like weathermen, right? Who they seem
Yeah.
like they know what they're talking about with their maps, but they're just guessing.
Well, I mean, weathermen, I would say, are actually much better than economists, because
Wow.
weathermen actually, like you'll have a hurricane, and they have this statistical map where they can say like 80% certainty, it's in this range. There's like a 10% that might be, somewhere in this range, but it's definitely not going to like make a U-turn or anything else. So they they both know something, and they also have like some knowledge about how precise, not accurate, but how precise their prediction is. Like they know that it's like a range, and they cannot narrow it down further, but they know that it's sort of a range, and that type of thing I think would be appropriate for macroeconomics. Also, there are certain things that I don't think we're at the point yet where you can be precise enough to say, um, you know, 3 months from now, the inflation is going to go from 3% to 7%. Then after that, it's 11%, or something like that. Like, I don't think we are at that point yet, but I think standard economics is just still just like stabbing in the dark, and they don't have a coherent theory. And so they don't really have anything. And so, a lot of times they'll just talk and say nothing in a very sophisticated way. Sometimes it's a very sophisticated way of saying, I don't know, who knows? And I would argue that CCT is unique, and that we have a coherent theory of inflation, which does a good job explaining empirical facts, um, and hopefully making some predictions. Um, and that's different. Like MMT does not really have a good theory of inflation. Austrians have that sort of, a lot of Austrians have that sort of simplified. For a while you had the quantity theory of money, but the basic, like this, the simple version of that is clearly completely wrong. Because the quantity theory of money depends on, is like, if you adjust the money supply, then it may take a bit of time, but price levels will grow proportionally with the money supply. So anytime you increase the money supply, you're increasing the price level, and that's bad. Historically, empirically, that's clearly not the case. And the thing is that if you go to the equation of exchange, MV equals PQ, the money supply times the velocity is equal to the price level times the real production. If you go to that equation of exchange, if you held everything else equal except for the price and then the money supply, then that would be true. But the thing is that in the real world, the velocity changes. I mean, that is measurable, and that is simply fact, that the velocity changes all the time. And most economists don't have any, like, I haven't seen any clear theories or ideas about what causes that to change. And to me, that is actually sort of where the meat of it is. Like, that's where you can, if you can, open up that variable and look at, what types of things can happen to cause the velocity to change, which we talked a little bit about in the last, in one of the last episodes, the crises of confidence episode. We talked about that a little bit, but that's where the really interesting stuff happens.
So like an example of this might be like when the pandemic hit, and when people got put out of work and they weren't buying food off the store shelves. They were, sitting in food lines for food pantries. And it wasn't that there was less money circulating. It was just the money slowed down. It sat, and it wasn't getting to the people who would otherwise be spending it.
Yeah, absolutely. So one of the things that can happen is like a sort of a Keynesian paradox of thrift deal, where people have money, have the same amount of money, but they're worried and they stop spending it. So velocity goes down. So your GDP goes down. Less production happens because people are not buying stuff because they're worried. So they're going to save their money. So inflation, the first thing that we have to say is that there is, according to CCT, there's two types of inflation. One type of inflation is capacity constraint inflation. So that is what happens in the 1970s. And if you know a bit about capital consumption theory, the paradox of the worker consumer from the 1940s onwards is causing spending to continue to rise in sort of this semi-stable way. And so capacity utilization keeps rising, spending keeps rising, and that goes from the 40s to the 70s. And by the time you get to the 70s, then capacity utilization is at 90%, which is the highest that we've ever measured before or since. And as it approaches that level in the 60s, that is actually when inflation actually starts nudging up, and it just keeps nudging up for the next decade until you get to the 70s, and you get 10%, 15% inflation in the US.
How high did our productive capacity get during World War II?
So capacity utilization figures from that far back are hard to find. Like the Fed website actually goes to 1970s, but Ray Dalio in his book and his description of the Great Depression, he's got lots of really interesting figures, and that was one of those figures that he had was that prior to the Great Depression, we were in the 70% in capacity utilization, and then in the Great Depression, it dropped into the 60s. So that's pretty much sort of where we are right now, also. But
Yeah.
anyways, capacity constraint inflation is when the paradox of the worker consumer causes the spending to keep growing and it reaches the limit, and factories cannot actually produce more goods. They cannot produce as many goods as the consumer worker is trying to buy and is able to buy due to their rising income. And so when you get to that place, and not all, but a lot of the factories are like near capacity, and it would be very difficult for them to like schedule more production into their factories, then their incentive is going to be, if I get more orders, I can't fulfill them, so that doesn't help me make more money. So how do I make more money? Well, I raise the price. And since there's all this extra demand, after I raise the price, I can still keep my factory busy and I'll make more profits. I'll have a higher profit margin. So it becomes profitable to raise prices. And that's because demand is hitting capacity constraints. And so that's what happens. The prices rise. And if you go back to the equation of exchange, MV equals PQ, you're at a place where Q has been rising until the 70s, but at this point Q is getting sort of constrained. So as MV increases, the MV, which is also like the level of spending, basically continues to increase. The only thing that can go up is P, is the price level. So that's capacity constraint inflation. That's what happened in the 1970s. Then you have like other cases of inflation, like Weimar Germany and Zimbabwe, and things like that.
Can I? Well, so let me ask another question then on capacity constraint inflation.
Yeah.
So is that how does labor fit into that equation?
Yeah.
I guess I'm thinking of the example of if Taco Bell can't hire anyone, they still have all the kitchen equipment to produce 1,000 tacos a day, but they've only got enough people to produce 50.
Yeah. So, very famously, there's this idea of the wage price spiral. And so the idea is that inflation is caused by wage price spiral, and wages go up, and then businesses have to raise prices, and then prices go up, and then workers have to demand more wages, and then this is a spiral, and it gets out of control. I would say that this is a terrible way of thinking about it.
Sure. But I guess my question is, where does that fit into your calculation of capacity utilization? If Taco Bell has the potential to make 1,000 tacos a day, they just don't have enough workers in there.
Yeah. So let me talk about that first. So if we were to put in a UBI right now, and capacity utilization is at 70%, so there's definitely more capacity available. Okay. But labor is actually, unemployment is not really that high, like 5%, historically over the past 100 years. That's not a high inflation. That's not a high unemployment rate. I remember, in around 2000, when I was learning high school, macroeconomics, we were at like 4%, and people were saying, wow, that is historically low. That's crazy. We never thought that unemployment could get down to 4%. Okay, and then it went further. It went down to 3%. Right. But anyways, if you only have 5% unemployment and you try to get like, say, 20% more aggregate demand, or 30 or 35% aggregate demand, clearly you cannot produce 30, you cannot get 35% more labor to produce that 35% extra aggregate demand and extra production, right? That's not possible. So what happens if you imagine that, the US has 150 million jobs and 150 million workers, roughly. We'll just we'll call the 5% negligible right now. We'll ignore that. It's roughly got 150 million jobs, 150 million workers. Now you put in UBI and you drive spending up 35%. You're going to have 200 million jobs now, but you only have 150 million workers. And so you're like missing 50, right? There's too many 50 million open job openings. What's going to happen? All the workers right now, we have lots of workers working for like $7.50 an hour, like really crappy jobs. When you have 200 million jobs, then the workers will all migrate to like the best job that they can find. So roughly, they won't be perfect at finding it, but roughly the best 150 million jobs will get filled, and the crappiest 50 million jobs will not be able to fill themselves. They'll not be able to find a worker.
So in that scenario, I mean, does that mean that we're at 75% of capacity utilization because we're only filling 75% of the available jobs?
No, capacity utilization and unemployment are completely separate, different measures measuring different things. Capacity utilization is going to the factory and saying, how much could you make? And then the factory says, well, we've got 4 production lines. Each one can make 1,000 widgets a month. So if we could sell them, we could make 4,000 widgets a month. That's capacity utilization.
Sure,
but we're only
if you had
selling.
if you had 200 million
factory.
factory jobs, potentially, if they were all running at 100% capacity, but only 150 million workers, then wouldn't you describe that as 75% capacity utilization?
No. So
No.
capacity utilization is different. So remember, we're at like 70% right now. So if we go up 35%, then capacity utilization goes up to 90%. The factories are as busy as they can be, but the economy has a problem: 50 million, job openings. And I'll actually say that this is confused, like sort of like just absorbed, like it goes around and around, and everybody absorbs it and assumes that it's true. And that paradigm, which goes back to the wage price spiral thing, is that like everything is focused on the worker. Like nobody thinks about like what the business is doing or what the business should be doing. It's all about the worker, and it's all about, workers are not working, or you don't have enough workers, there's not enough labor, blah blah blah. That's completely wrong. That's completely insane, because 200 million years ago, we still had the same amount of labor supply per person. We probably had more as we do now. We still only have 24 hours in a day, and we have to sleep. And we're producing 100 times more goods. So clearly, labor is not the limiting factor of how much you can produce. And why is it not the limiting factor? Because of capital and accumulation, and because of technology growth, which I consider to be a more broad type of capital accumulation also. Like somebody has to invest into the science and the engineering and the innovation. And then once it's done, then you've got like higher productivity, more capacity. That's a type of capital accumulation I would consider. And that is the key. And it's not labor, right?
Well, yeah, except
Right.
if to the extent that you do need labor to get to 100% capacity utilization, if you don't have that, then that's my question.
Not to get to capacity 100% capacity utilization. Capacity utilization, it is, again, it's not directly strongly linked to labor. But we do have a problem right now that we increased our aggregate demand by 35%. Factories are full out, but the thing is that we used to have 150 million jobs. Now we have 200 million jobs, and we only have 150 million workers. So there's 50 million open job openings.
Right.
Businesses are looking for workers, and they cannot find them.
Right.
What are they going to do?
Well, right, that's what I'm saying. So doesn't that drive down capacity utilization?
So in the medium run to long run, what they're going to do is they're going to automate that job, or they're going to eliminate that job, or they're going to enhance that job. Like they're going to figure out some way to make the job more important and be able to pay the worker enough so that they can actually grab a worker in this really tight labor market, where there's 4 jobs for every 3 workers. That's what's going to happen. You know, that's what happens, is that the labor is scarce, and when you have a scarce resource, markets are very, very good at adjusting the economy to deal with scarce resources. When the scarce resource gets scarce, its price goes up, and everybody figures out how to get along without it, right?
Oh,
That's what
sure.
markets do. Yeah. You know, when Europe puts like a 300% tax on gasoline, then everybody in Europe starts, driving smaller cars, hybrid, et cetera, et cetera. And their fuel efficiency in Europe is like way, way higher than in the US, because the US has 0%. We have subsidies. I understand. If I remember correctly, we have subsidies on the gasoline. So,
Ethanol.
so everybody, drives the most, the biggest, fastest, most hungry car that they can find. And they use lots and lots of gas because it's super cheap. So why not? I mean, those cars are kind of fun, right?
Yeah. I mean, there's
So
some
the same
truth to
thing
that,
with
but
businesses.
those cheap transportation costs also affect the way your businesses and their supply chains and things work, right?
Yeah, absolutely. And most things can adjust to different levels of scarcity by adjusting. That is the whole point of markets, is that you have scarce resources. This is Econ 101. This is the whole point of a market. You have scarce resources. The price adjusts to reflect the scarcity, and the need for it. And as a result, you balance it out. Like some people like figure out that if this is super, super expensive, maybe I don't need it after all. Maybe I can get by with a hybrid or a Tesla. I don't have to, guzzle like hundreds of gallons of gasoline a year or whatever.
Although some
The
people do
economy,
without, even
business.
if they can't do without, they do without anyway, just because they're driven out of the market, right?
Yeah. Well, I mean, so for most things, so okay, so let's focus it on labor. So labor's getting really scarce. Businesses can't find enough labor. Price of labor goes up, and the ones and businesses automate, so they bring up productivity growth. So if your worker is paired with a large amount of capital investment, he's managing an automated robotic factory or warehouse, and the one worker, like, can oversee robots doing like, you know, thousands of, packages a minute or something. Productivity goes way up. And suddenly you can afford to pay them that high price. That's what businesses will do. They will, use the scarce resource very carefully. And particularly, they will do that by pairing it with capital investment, because that's exactly what capital investment is. In CCT, the very definition of capital is it enhances productivity. Even if you're Robinson Crusoe on a desert island and you budget half your time to, setting up a system of nets, which like traps the fish so that every day you have fish to eat, and there's an investment in the beginning, but then every day after that, instead of having to spend like 3 hours, trying to get the fish on your pointy stick, you just come to your nets and then like scoop them up. Suddenly you're saving 2 hours every day because you had that investment. Businesses do that all the time, but they're going to consider what the cost of labor is. So if labor is super, super cheap, and it's a big investment to automate, all this stuff, my factories and whatever, then it's not going to be a good return on investment. If I save the labor, but the labor is super cheap anyways, then my return on investment is really low. But if we send aggregate demand up and suddenly late wages are like $30 an hour, your labor cost just tripled, then suddenly, lots and lots of types of automation start looking really, really good. They do the flippy, the automatic, fry cooker, tons and tons of stuff. That technology is absolutely there. And I would argue that because of low wages, that is very, very slowed down, because businesses are not incentivized to do that investment if labor is cheap. That is why there are different equilibriums in the economy. I think Joan Robinson talks about this a little bit, just getting into her work a little bit. She talks about this a bit, but that's what happens. You can have high wage labor, and in the economy that will drive like high capital investment, or you can have labor, excuse me, low wage labor, low wage labor, and businesses will not do as much capital investment and not get as much productivity growth because it's not a good return on the investment for them. And then plus at the same time, those low paid laborers, they're not going to be able to buy very much stuff. So that also impinges on, why are you going to say enhance the productivity of your workers and allow, the 1,000 widgets to expand to 10,000 widgets with the same labor force when the worker consumer can't even buy the 1,000 in the first place. They're only buying like 800 a month. Why am I going to expand? Why do I need more production? I don't. That's exactly where we are.
All right. So should we
Right.
talk about inflation?
Right. So how does this tie back to inflation? The wage price spiral. That's another one of those, like, that floats around. It's not empirical, but like it's always in like people's articles. People are always talking about it, always thinking about it, and it just drives this bias where everybody's thinking, oh, no, 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 we don't want wages to go up. If wages go up, then prices are going to go up.
Well, I mean, to be honest, I mean, that's kind of the way that I see it is if I see prices going up, I like to think it's because the workers are making more money now, right?
Well,
Which
right,
isn't
but
necessarily true, but
that is absolutely not necessarily true. That is 100% an assumption. It could easily be that the business is simply making more profit.
yeah, no, I know.
There's zero guarantee that a higher price goes to the worker at all.
No, I recognize that, but I do see like the billboards up and, everybody's
Yeah.
hiring, 10, 12, 15, $18 an hour.
Yeah. I mean, that is good thing of the current era, and we'll get to that. But I will say that the wage price spiral, if you think about it, the wage price spiral is also the labor income consumer spending spiral, right? Spoken differently, like the price is the price, and then spending is, like spending, but essentially that's the same spiral. Wage price is the same spiral as consumer income, labor income. So if labor, it's looking at the income as an expense instead. So if labor expense goes up, then you say, oh, then prices have to go up, and if prices go up, then labor expense has to go up. But if you look at it as a flow instead of a price in the opposite direction, if the labor income goes up, then the consumer spending can go up, and then the labor income can go up. It is actually the same loop. But when you look at it in terms of the paradox of the worker consumer, and you also look at the evidence, when do you get inflation? Because you had, huge wage increases in the 40s and the 50s, but you didn't have inflation at that time. And then you've had, and then so they're not connected at the hip, but
when you say we didn't have inflation at that time, you mean like we had low inflation or literally no inflation?
Low inflation.
I honestly don't know.
We didn't have inflation problems. We had low inflation. There was like a little spike after World War II, which is a little bit to do with the war. But generally, over that
sort
era,
of in the same way that we're seeing a spike now, which is all of a sudden people have extra money to spend, and so they're going out to spend it.
Well, it depends on what happens in the future. We can see what happened after 1940, but we don't know what happens after 2021 yet. Right. But anyways, the point is it was low, even though the wages were going up, low inflation in the 50s, in the golden era. The only time when you get rising prices again is in the 70s when you hit the ceiling of capacity constraint and the business cannot actually produce more. And so when that happens, then that does become sort of the wage price spiral. So it is sort of true for that one period of time. In the narrow, unique, specific case that you were at the limit of your capacity constraint, then you can get that type of action where the worker is earning more, so they're trying to buy more, but because you can't actually make more, the prices just go up. Um, and you can get wages going up and prices going up. Um, and production is stuck. But it only happens because you're bumping up against capacity constraint. Because if you were not bumping up against capacity constraint and labor income went up and spending went up, the businesses would say, wonderful, I've got 10% extra capacity in my factory anyways. So if you're going to spend more, my revenues are going to go up. My fixed costs are going to go down as a percentage of my revenues. So my costs are actually going to go down as the spending goes up.
Mhm.
So this is, brilliant. My profits go up. Why am I going to upset this? This is just perfect. This is good. I'm
So
not going to
that,
raise prices. I want people to keep buying more. That makes my business more profitable for revenues to go up rather than through an increase in quantity. When I can do an increase in quantity, that is better for my business. But when it's only when I cannot do an increase in quantity that it becomes, well, if I can't increase the quantity, I'll just increase the price. And so you get inflation.
so that capacity constraint that we hit in the 70s, where was that level set? I mean, was that back in like World War II? Did we set that high threshold for the amount of
I
and
think you're
then
trying to
it fell, and then we spent
right.
30 years working back up to get back up to.
Like it sounds to me like you're trying to understand how capacity utilization is measured. Like
Yeah,
what
that's
does
part
it
of it.
mean?
Yes.
That's what you're trying to ask. Right. So capacity utilization is economists, they go out to like, all the factories, the primary industries, secondary industries, factories, oil, uh, drillers, the natural resource, the lumber yards, everything. They go to all these places, and at each place, they stop there and they ask the question, if this lumber yard or whatever was producing at full capacity, it was producing as much lumber as it can with the productive resources that it has, referring to like, they've got the sawmill and they've got the equipment basically based on the equipment that you have. What's the most that you can make? They ask that question. And then utilization is like, how much are you actually selling? If you can make 1,000 widgets a month, using your factory that you already have and not
Mhm.
building any more factories, and you're only selling 800, then you're at 80%.
Yeah.
That's capacity utilization.
So that's kind of
So
my question is like, did we have this 1,000 widget a month capacity during World War II? And then after World War II, it scaled back down to like 60. We were only using 60%. And then by the 70s, it worked back up to the top. I guess that's kind of my question.
well, it's growing all the time. Capacity is always growing.
So why, I guess, so then why? If we're
Like
not utilizing the capacity we already have, why are we continuing to increase the capacity?
Because so I think you're talking about from like the 80s until now. So this era of stagnation that we have,
Okay.
and capacity utilization is going down. And so the question is, if capacity utilization is going down, why are the businesses not adjusting and saying, we don't need this much capacity? Let's stop building so much capacity. Let's only use the capacity, build the capacity that we need. That's a wonderful question. That deserves inquiry. Like, why would businesses do that? That doesn't make any sense. But like, if they're trying to be efficient, they should try to minimize the capacity. And so the only way that that makes sense is if you realize that I need to do a diagram soon of the economy. So you've got the economy, you've got the economy, the consumer worker, and the capitalist owns the factories, and the capitalist is making lots of money. They own all the factories. They're making tons of money. You know how billionaires are. They just, money, in the wallet day in, day out,
Yeah.
sloshing around in money. What do they do with it?
Build
Imagine you're a
spaceships, go to
billionaire.
Mars.
Yeah, sometimes they go to Mars. Most of the time, what they do with all of that money coming in is that, if they're earning like $10 billion a year, um, if you go and try to spend that much, and like a billion is like, like most people don't deal with billions on a daily basis. This is a million. No, this is 1,000. Sorry, I almost did a CNN. This is 1,000 millions. Okay. If you make $10 billion in a year, divide that by 365, that's divided by 1,000 times three. So 10 billion, 10 million, 30 million. Every single day, you're bringing in $30 million on average. Brian, you're now a billionaire. Congratulations. What are you going to spend your $30 million allowance today? What are you going to spend it on today? You have to spend it today.
I'm gonna start a new political structure to challenge the duopoly and
You now understand why Jeff Bezos is going to space. What else is he going to, what else is he going to do? Every single day, day after day, you can eat every day, you can sleep every day. You only need one house to live in. I mean, you can buy like 100 cars, but you're probably going to get bored after that. You run out of things to spend it on. And I'm
Right.
illustrating the point. If you look at the data, once you get to about $400,000, I think if you get to $700,000 a year in income, those people on average spend 400,000 and they save 300,000. If you look at savings rates, like the bottom 90% just does not save essentially. On average, they just don't save money. Sometimes they go into credit card debt. In top 10%, top 5%, top 1%, if you're making 700,000 on average, you're going to spend 400,000 and 300,000 just gets saved. So where does that go? That goes into investments. Like you don't want it to sit in the bank and not do anything because, as a capitalist, you're really aware that you can take that 300,000, pop it into investment, and next year it's going to grow and it's going to keep growing, and that's just that's wonderful. Like you're going to get richer and richer, right? So that's what you do. That's why you're there in the first place, because you understand that. So you're saving your money. So the money that the capitalist makes from all their factories, it just goes back into building more factories. But now we're in a situation from the 1980 until now that the consumer worker doesn't have enough money to spend to actually keep the factories busy. So the capacity utilization is dropping, and that's really weird because you would think that businesses would be efficient. But the thing is that essentially they are being efficient. But the thing is that all the capitalists have all this money to spend. If they don't build factories, what else are they going to do with it? It's really hard to spend it because it's so much. What else are you going to do? You could go to space. And that is exactly where we are today. That's why the capacity utilization goes down. It should never do that if the economy were actually efficient. This is an inefficiency. But that only happens because it's backing up, because this income is coming here. It's got nowhere else to go. So you go into ever more and more marginal factory investments.
Well, then let me go back to between this period between the 40s and the 70s, where we had higher tax rates on the wealthy.
Yep.
So that they didn't accumulate as much capital, which you're saying otherwise would have been invested in productive capacity.
Yes.
And so because we had the higher tax rates, that didn't get invested to capacity, which is why in the 70s we started bumping up against our capacity constraints.
So generally this is a wonderful thing. So if we did like high taxes right now, that would solve like almost all the problems. And the CCT view is that because the problem is that inflationary top, all this capital stuck at the top, and it has nothing to do because if you build factories, they're not going to be busy. But you got to do something. So you invest in marginal factories, and then when you're done doing that, you start buying Bitcoin and real estate and commodities and gold. That's what you start doing. Um,
I mean,
I
but
lost
some
my
people do
train.
other things too. Like there's a lot of philanthropy
Yeah,
that
I
goes
mean,
on,
there's
right?
some
That
philanthropy,
doesn't
and that
increase
that
productive
that's
capacity.
good. Right. What I was saying is that if you so you have the inflationary top and the deflationary bottom, people struggling at the bottom, and this is a capital consumption imbalance. It is a problem. If the only thing you did, if you actually did not implement UBI, but you just figured out a way to be really effective at taxing all this money out of the top, and like Jeff Bezos suddenly like just tens of billions of dollars are just here you go government, here you go government, and you just take it out of the top.
Mhm.
And we could even say that if the government is sort of weird because this is a thought experiment and they're just going to just bury that money. So like Jeff Bezos, like they go into Jeff Bezos's uh, bank account and his stock account and everything. They just chop off one half, gone. That's confiscated, not yours anymore. We're not going to do anything with it either, but it's just gone. What would happen? I would suggest that what would happen is that you would actually regain capital consumption imbalance. You would regain balance. So once you've taken that out, then the capitalists now don't have very much money to invest in stuff. The workers don't have much money, but the capitalists don't have much money either. So what's going to happen?
So capacity utilization will increase because there isn't new capacity coming online.
Yeah,
So,
but even sooner than that. Well, the
um,
consumer worker can't spend money because they don't have money in the first place. And the capitalists can't spend money either because the government just took all their money, or like half of it, or two-thirds, or whatever.
wait, why can't the
Their
workers
pockets
spend money?
are empty. Because we're in this thought experiment, we go from the current era, 2021, and then in 2022, like there's this, Bernie Sanders rises and to the president. Congress is taken over by 80% progressives, and they're like, okay, billionaires shouldn't exist.
Okay,
If you're a billionaire, 90% of your wealth, we're just it's gone.
sure, but so what happened to the worker? How come the worker doesn't have money to spend? Aren't they still
They don't
working?
have money to spend right now because they're being paid 750 an hour because they don't hardly get paid anything because they're being paid 750 an hour. Their labor income is really, really low. That's true right now. And then we're doing a thought experiment. Now the capitalist also does not have money to spend because the government just took it all away. What happens now?
I I don't know. I'm still sticking with capacity utilization increases because it's not being added to.
Later that will happen. But
Okay.
the immediate effect is that sometimes economists will talk about the consumer and I think called the investment sector of the economy, right? Which is also what we're talking about basically. And you just chopped off the investment sector, like they don't have money to invest anymore.
Right.
So the consumer sector, like we are saying, is already like in the dumps. Like people don't get paid hardly anything, and now the capitalist doesn't have money to spend either. What happens? Supply and demand. The classical economist, Say's law.
Yeah, I'm not sure where you're going with this.
So Say's law is that like basically that prices adjust. So if both the top and the bottom don't have money to spend, then everybody who's selling anything, including people who are selling consumer products and including people who are like business to business selling things to other business, like nobody can find business. So what are they going to do?
Okay, so you're saying deflation then is if
Yeah,
all if
yeah,
if
you're
we
going to get
remove a big
deflation.
chunk of money from circulation,
Yeah.
You'll get
Right now
deflation.
you've got
Okay, I
the
got you.
deflationary bottom paired with the inflationary top, and it's holding the price steady, for the last 20 years, more or less. And now the inflationary top is no longer, you took a huge chunk out of it. The whole thing's going to go down in terms of the prices are going to go down. Like all the businesses, they cannot find customers. The natural resources, all the resources in the economy are going to go really, really slack. And when that happens, what are business going to do? They're going to say, I've got to drop my prices
Okay.
because I need customers.
I guess I'm lost on the part where why do the workers at the bottom have less money? Where is their
They don't have less money, but they have the same lack of money that they already do right now. But right now, even though they don't have money, but prices are still stable and some prices are actually going up. They're still getting crushed
right?
because you have investments spending, holding prices up because the Fed is cramming money in there and
Right.
they're making money anyways. Anyways, there's like sort of there's more investment spending. It's inflationary at the top. But if you take all that money out, it's no longer inflationary at the top. And then you have a deflationary top and a deflationary bottom, and you would just have deflation. Price of everything goes down, right? So when the price of everything goes down, you're not convinced.
I'm not convinced. I guess I'm missing something, but it's probably it, right? But if you're, your worker's making $20 an hour or whatever, and that buys him, that
No,
pays
no,
his
he's
rent
making
and
he's making 750 because we didn't put in UBI.
okay,
All we
but
did was like take money away from the capitalist, but we did not give it to the worker
so
consumer.
I guess so you get deflation when his money gets scarce, right? And so he
Yeah.
wants to spend less, and
When
then that is
right,
that
when
right?
spending gets scarce because the bottom doesn't have much money income to
Okay.
spend, and the top's income and money and everything just got taken away.
But what
Um,
they're spending, they're spending on something completely different. They're investing in productive capacity and everything. So if they
that's
stop
true.
spending on that, how does that change the price of bread for
Yeah,
me in the grocery store?
but
That's what I don't
but
understand.
the thing is that when you spend on productive capacity, that also draws on resources. So that also draws labor resources, right? So when you build a factory, then there's going to be lots of labor, like working to build your factory. You're going to buy like a lots of cranes. You're going to buy concrete. You're going to buy
Okay.
there is resources. Part of the production of the economy is capital production,
Okay.
is building factories. So if you build,
All right.
$100 billion worth of factories, that's in the GDP, right?
So
But
okay.
now
So
you,
what you're saying is that in your scenario, when you take that money away, you're
yeah,
throwing out of work all the people who would be building the extra capacity.
yeah.
And
So
that's what's
there's
throwing the economy off.
huge deflationary shock. But again, it's not the worker. The worker's not the key. All the rest of it is the key. The businesses, the whole thing is the key. The worker is just one small part. Don't focus on the worker. That is the mistake that all the economists make. It's not the
Well,
worker.
I'm in good
It's the
company
whole
then.
economy. So the whole economy, used to have, this huge chunk of investment, real investment activity, and that's getting cut off. So everything is slack. Labor gets slack, capital gets slack, everything's slack. All the businesses just, don't have
So
money coming in.
So, okay, so two different
So
scenarios. What
activity is
if
going to
are
slow down really, like activity is going to crash for a little bit. But after activity crashes, what are they going to do?
all right, so in two scenarios. In the first one,
Yep.
you're the people at the top who are spending this extra money, they're just investing it in moving money around, like investing it in the stock market and futures and what everything. And in the other scenario, they're investing it in building excess capacity.
It's not binary. They're
So,
investing in gold and Bitcoin and commodities because for the last 40 years they've been trying to invest it in factories, but the more factories they invest in, the emptier the factories are. So that the factory investments just keep looking worse and worse and worse. But this is true across the entire economy. nobody has like really great real investments, and the capitalists are still making all this income. So all this income is backing up at the top, which like in a healthy economy, it would go into, this investment, but the investment's looking terrible. But then they look around, well, what else can I do? There's nothing else they can do. So it just gets more and more marginal. You just do the investment that you can. Um, but yeah, I mean, we're to the point where at the very end point, you're like, um, if you're a company, you just buy back your stocks. If you're Ray Dalio or George Soros or anybody else, you buy gold. Um, you buy commodities because I keep up with finance, and for the last 2 years, 3 years, that this has been a huge trend. I don't think I can't name a big investor or finance guy who's like super bearish on gold and super bearish on commodities. Like they're just, they're not out there. Some people are bearish on Bitcoin because it's new and they think it's really weird, and it doesn't make sense. But nobody's gold bearish on gold and commodities, and nobody's like super bullish on the dollar. Like nobody is saying treasuries is what you got to buy. Nobody's saying that. It's impossible to make the case. They're yielding negative real returns. This is going to be one of those tangent episodes. So at this point, I must apologize to the audience. Like today, we are just going to talk about like whatever, wherever we go. So hope
Eddie,
you guys enjoyed this instead of the money demand stuff.
well, we're
But
like 50 minutes in. So if you want to just
yeah,
make it a two-parter as not to scare anyone off by a long runtime, we could do that.
a two-parter. Um, I don't know. How's your? We could do that. Why not? So let's keep talking because I think there's still some stuff going on here. So we'll talk. This is the tangent episode, and then maybe we'll do like money demand like in 2 more weeks.
Okay, go ahead.
Okay. So what are we talking about anyways? Yeah, it's graded. The first thing is they try to buy, the factories, the real investment, but that gets more and more marginal. So they're still trying to do it, but it's really tough. And then, at the very end, they end up also, moving more like shifting their allocation towards, more gold and commodities and whatnot. So we were talking about if you just tax the heck out of the rich and you like decide there's going to be no more billionaires and 999 million is all you can have, and the rest, is just kaput and gone.
Yeah, it's
Right.
like
So
one of those video games where you can only have so many rubies or something, and then it
yeah,
just
and
stops
then it
counting.
goes back to zero.
Right.
Super Mario's. But anyways, the point is, um, there was still, like I say, like real investment is frustrated, but it's still going on. But now that you've taxed it all away, the top is also deflationary. They also don't have income, and it's all gonna spiral. It will do that Keynesian thing, and like nobody has money to spend. All crashes for a little bit. What's gonna happen? It's gonna be deflationary. Like if you're sitting in a business and nobody's coming in, and every business across the nation is in this situation, they're going to lower their prices. They don't lower the prices right now because to some degree right now, and Alex Hallett, I think, sort of talks about this a bit. He talks about this a lot, and I think he's correct about this. We talk about this in black and white, but you actually have to like grade everything, like fuzz it out. It's not that black and white. You've got lots of money people who have no money, at the bottom or very little. I should say no. You've got capitalists, they have money, and then you've got like upper class professionals. Like there are some people who have money and can spend money. You're going to end up with an economy that is geared more towards like the luxury segments. Like that's where the money is to be made. Like the Whole Foods and the nice brand names and the nice cars. Like if you want to make any money, those are the only people who have money, like the capitalists and like the capitalist adjacent, like
Yeah,
upper management, highly educated, lawyers, doctors, whatever.
right.
They've got
Well,
money. So that's
yeah.
where you get your um that's what your economy adjusts towards.
And so that, I mean, so you see that with
Eh,
people who start their businesses being like life coaches and things like that,
Yeah,
where they
yeah.
want
It's
to
all it's
persuade
all
someone who
about
has lots of money to pay them, $10,000 to be
yeah.
their life
It's
coach.
all about catching those whales
Yeah.
in crypto terms. And it's a little bit like in Econ 101, you have the problem of like segmenting markets. So
Mhm.
like movie theaters, when they can segment different markets that have different incomes, then they'll have a higher price and a lower price. So if you're a regular adult and you make money, then you pay, I don't know how much you pay nowadays, $10. But if you're a student and you're poor because you're a student, you're not making money yet, you only have to pay $5. It's the same thing, but they maximize the revenue by charging the people up here with income more, and then the people down here less. In the whole economy, that happens also, but a lot of things cannot be segmented. They can't means test you when you walk into Whole Foods and say, well, if you don't have money, then you can, everything's half off. They can't do that.
Mhm.
So they just ignore the bottom segment, and they just sell to the upper segment at a high price. So prices in the economy stay up. And it's just the ones at the bottom, can't afford anything, and they just struggle. But you
And
have
so this
price
is, and so
PI
this is a
stuff.
factor from as a result of wealth inequality, right? If so, 40,
Yeah.
50 years ago or whatever, where
Yeah.
the income distribution was much closer together, you
Yes.
saw less of this segmenting, right?
Absolutely. Absolutely.
Yeah.
Right. So if you get this deflationary crash, then the money supply, which is the base money supply is not contracted, and let's like assume that you don't have a debt crisis here. You still have money. Um, what am I saying? Oh, so you get the deflationary crash, and then as you get the deflationary crash, when prices go down, what does that do to the money supply? What it does is it drives the real money supply up. Like even if the money supply does not change or doesn't change very much, but if the prices go down, then the real money supply actually goes up. And so suddenly, what's going to happen is Say's law is going to happen. Like you will equilibrate in the situation, and you'll have like all the prices go down until everybody has enough money in real terms to actually like run the economy again.
Um, I didn't quite follow that. So why does the money supply go up in a deflationary cycle?
Because say you have like a $20 trillion money supply, but the CPI, the price index is just crashing because nobody is spending money, and businesses keep lowering their prices trying to get anybody to come in the door. Then suddenly your $20 trillion, if your CPI goes down by half, then suddenly the $20 trillion is worth twice as much in terms of real goods.
Okay,
So you're $750 an hour, maybe it
gotcha.
stays $750 an hour,
Yeah,
but then your cost of living comes down from like 3,000 a month down to 1,500. Suddenly 750 an hour is not a bad wage. Like you just
right.
doubled your wages in
Yeah.
real terms with deflation in
So
this
yeah, so when
scenario.
you say money supply, you're not saying specifically the quantity of money, you're saying the purchasing power of the money supply goes up. Is that right?
Right. Yes, that's what I mean by the real money supply.
Real money. Okay.
Real as an indexed to inflation, indexed to
Gotcha.
prices. So the nominal money supply, maybe it stays around the same or maybe only changes a bit. But if your prices come way down, then indexed to the prices, that right, the real money
Okay.
supply actually expands.
Gotcha.
So that's capital consumption imbalance. Um, So
So,
I think we've been going for like an hour. So
yeah,
I've got no idea what this episode was about, but I'll go back and look at what it was and figure out a title for this. So thanks everybody for listening. Thanks for being patient with us. Hope you enjoyed this winding tangent and hope it was informative. See you guys in the next episode.